Many investors on Esketit are suffering from cash drag, which means they cannot get their funds invested due to the limited loan supply. The auto-invest feature don't work properly and the primary market constantly shows zero available loans. Uninvested funds don't earn any yield, which is why investors can either withdraw the funds and invest elsewhere or explore the available investment opportunities on the secondary market. The secondary market on Esketit usually offers plenty of loans in which you can invest. Keep in mind that most loans are listed at the premium price. This means that you are paying a percentage of the outstanding amount as a fee. The outstanding amount is represented in the price column. The fee ranges from 0.1% to 2%, which may seem like a low amount to less informed investors. The fact is, however, that even a fee of 0.9% can wipe out all of the interest that you may earn from this particular loan. A fee of 1% can even put you at a loss. So let me explain. The return you make from secondary market investments depends on three factors: the offered interest rate, the remaining loan term, and the fee, which is determined by the investor who is selling the loan. On Esketit, the fee is represented as a premium and marked in red. The platform also allows investors to sell loans at a discount, which I have never seen, or at par, meaning there is no discount or premium. In over 99% of cases, loans are listed with a premium, which represents a fee for the buyer. The fee is always lowering your return on investment. Let me demonstrate to you the impact of the fee on your investment in a loan with a maturity of just 30 days and an annual interest rate of 11%. As you can see in the chart, the fee has a strong impact on the internal return rate for short-term loans. This is because the short duration does not allow enough interest to accumulate and compensate for the premium. This can lead to significant losses at the higher premiums. In our example, a premium fee of just 0.9% means that you will earn only 0.13% on your investment on the secondary market if you buy a loan with a repayment schedule in 30 days. The shorter the repayment period, the progressively less money you make if you buy a loan at the premium price. Let's review an example of a loan with a maturity of 12 months and regular loan repayments. As you can see, the decline in the internal return rate is relatively moderate and gradual as the premium increase. Even at a premium of 2%, you are still earning a return of 7.37% over 12 months on a loan with an initial interest rate of 11%. For the 12-month loan, the impact of fees is spread out over a longer period, so the reduction in the internal return rate is less drastic. As you can see, there are plenty of loans on the secondary market with loan maturity of less than 30 days and relatively high premiums. Investing in those loans will cause buyers to lose money. Remember that the shorter the loan period, the more affected you will be by a higher premium. Investors should be cautious about paying even a small premium for short-term loans, as the compounding benefit of interest over time is minimal. To learn more about how to not lose money by buying loans on the secondary market, read our Academy guide on P2P Empire. Follow P2P Empire for more tips about P2P lending. Watch this video to learn more about the latest developments in the industry.